Okay, hi everyone. Before we begin, just to let you know, this is not financial advice. The purpose of this video is only for educational purpose. And Jason and I today, we are here to share our strategies with you on how we compound our wealth. So recently, there has been an article that I was interviewed whereby that states that more than 400,000 CPF members have at least 500,000 in their account. And what's more shocking is that 100 of them are actually 35 and below. So ever since I was interviewed for this article, there have been a lot of questions on how do we optimize our returns for CPF, and many of you have asked me to go into more details. Now, the best way to compound your CPF wealth, especially when you're in your 20s, 30s, and 40s, you have sort of like a more than 20 years of long runway to go, is to invest your CPF money in the equity market. It is not by transferring your OA to your SA, and neither am I an advocate of topping up your SA voluntarily with cash in order to do tax savings. And the reason why is this: when you put your money voluntarily into your SA, it restricts the amount of financial products you're able to invest. And when even after factoring the amount of tax savings you would get for voluntarily topping up your SA with cash, your investment returns, when we look at beyond a 20-year period, it's not going to deviate very far away from the 4% offered by CPF SA. Because when we are looking at a super long period, even if your tax savings is in the 20 or 22% income bracket, it is not going to deviate from the investment returns of the investment product itself, which is why when for young people, I would strongly advocate you considering entering into the equity market in order to optimize your CPF returns. Now, here's why. When we look at the stock market, even though there are going to be bad news every now and then, there are going to be pullbacks for sure, but over a long period, the stock market will be trending upwards. Even though future returns are not predicated based on past results, but the probability of them continue to rise over the long term is extremely high, largely because the economy will become more productive, people will consume more, and of course, there's always inflation, and the stock market value will rise accordingly. Definitely not in a straight line, but over a long time, it will most probably be rising. And based on historical study, the odds of you losing money in the S&P 500 will dramatically reduce as you broaden your time period. So if you were just investing for one day, odds of you losing money is 50%. And if you broaden that to over 20 years, the odds of you losing money is actually 0%, right? And the average return for investing in the S&P 500 for over 20 years is generally around 10% compounded annually, which is why, especially if you're young and you have a long holding period, it is wise to go into the stock market. Now, this advice wouldn't hold as much for people who are nearing their retirement, because you should only invest in the stock market money that you don't require in the next few years. So which is why for people who have just started working or are in their 30s or 40s, if your OA is not being used to pay your housing, etc., you can consider investing the excess into the stock market. Now, but navigating through the complex web of CPF requirements and getting started investing using your CPF money is not exactly the easiest thing to do, which is why today we have invited Jason. Jason is from the wealth management industry, and he will be going through how much of your CPF money can be invested, what we can consider investing in, and how do we select funds that will best fit our investment objective. So Jason, I'm going to hand it over to you.
Okay, Ken. Thanks, Thomas. CPF OA investment users, okay? Whenever I talk about CPF investing, okay, I focus on CPF OA first, okay? Under the typical usage of CPF, okay, you realize that if you want to invest in our own stocks, Singapore stocks, for this, only 35% of the accessible ones. So take note, only upon the first 20K is achieved, set aside, you can then use the excess for investments, okay? So with that in mind, the 10% that is catered to gold is the limit that you can use for investment. Yet, however, if you look at unit trusts, if you want to invest in your funds, you can use 100% of the excess funds there.
Yeah, so this is a good point, because initially when I started investing using my CPF money, I only utilized the 35%, because when we invest directly in the stock market, CPF actually restrict us to only using 35% of our money, those that are above 20,000. What I didn't know is that up to 100% can actually be invested, which is why it totally changes the game for me, because right now I'm able to fully maximize the amount of returns given my long runway to compound my CPF retirement wealth.
Yeah, correct. So you see, once we have more informed knowledge out there in the market, we can then make some changes to our investments. It's a process of fine-tuning it, like what I always say. We all start from somewhere, but eventually, as it gets longer in the game of investments, we realize that our strategy can change. Certain strategies can be changed. Okay. So for the case of using CPF investment, okay, how do we go about doing it? Simple. We have to actually open a CPF investment account with our local banks. So these are three local banks: your OCBC, your UOB, and DBS. So in order to kickstart your CPF investing journey, you have to first create this. And to create this, actually, you have to go through this thing called the self-awareness questionnaire. What it does is that it tests your knowledge about investment concepts, products, and the charges involved sometimes. So once you have created and successfully passed, okay, you just have to wait for your account to be approved. Okay, usually it's around 7 days, usually, time period. And once it's been approved by the bank, that's when you can move on to the next stage. Okay, so how do I go about looking to where are my options available? Okay, my own personal experience, okay, Endowers. Why Endowers? Because it's the first robo-advisor that can use your CPF, your cash, your SRS investment through unit trust with very competitive low fees. So you look at it, they actually package it in a way that there's 3 different tiers you can choose from, which is very easy and convenient for mass market investors to kickstart their investment through CPF also, I feel. And okay, so if you look at things, right, iFast side on the other hand, why did I chose iFast is because it's a global wealth management fintech platform also with access to 300 funds available to invest in. Of course, there's restrictions for CPF investable funds because of the fact that I think CPF wants to restrict the high risk elements involved. They want to make sure that these are funds that have track records for CPF members to choose from. Okay, which is why there's always restrictions for the number of funds available when you use your CPF. But that being said, doesn't mean that there are no good quality funds out there for us to choose from. We have done our research. We should be able to find quality ones as well, which I will share later on. How did I manage to do so?
Yeah, so personally, right, I use a mixture of Endow Us and investing directly with the stock market. So Jason rightly pointed out earlier that in order to start investing in using your CPF money, you first have to open up your CPF IS account with one of the 3 local banks, DBS, UOB, or OCBC. But after that, it's not 100% that you have to invest using the brokerage account of these 3 banks. You can actually open up with iFast, they call it the Fund Supermart, or you can use Endow Us. So generally what I do is, because I like to research stocks and I like to buy stocks directly, I would use up the first 35% to invest in the Singapore stock market first. Then subsequently the excess, then I will consider using Endow Us or invest into unit trust. And today, Jason will be walking us through how can we actually sort out finding unit trust. What are the things we need to look at, the returns, the fund manager performance, as well as the fees charged. But for investors who are a bit lazier, then you can consider Endow Us. Endow Us is actually highly customizable. So for myself, when I invest through Endow Us, right, I only buy the S&P 500. You are able to customize based on what are your risk profile that you like, etc. So it's actually you have quite a lot of say as to what you want to invest in despite using the robo-advisor. Yeah, back to you, Jason.
Okay, thanks, Thomas, for sharing. Okay, so back to the topic of investment through CPF. So after looking through our research, then we can decide on the investment strategies to kickstart the journey. So what I do is usually I tell young adults who are in the workforce, okay, there's this thing that you need to consider, okay, which is your high growth versus your stable growth. Which should you choose? Okay, sometimes everyone has a different risk appetite. Whatever you have been exposed to in the investment world, right? Okay, might be different for different individuals. So for me, I always tell people there's this option of going 100% to equity, or maybe perhaps 60% equity, 40% bond. Okay, depending on risk appetite. And once you have this sorted out, okay, then you move on to the next thing, which is, do you then do lump sum investing? Do you then do dollar cost averaging on a monthly basis? Okay, so these are the 2 different thoughts investments.
Yeah, so 2 things. One on the high growth versus the income strategy. So personally, for myself, I'm 100% equity because when you have a long runway, I don't see it as a necessity whereby you need a bond holding, because given the low interest rate environment, bonds are not going to return you sufficient interest for you to generate sizable returns for your retirement. But if you are closer to your retirement, then that's where I think it's more prudent for you to have a mixture of equity and bond holdings. Jason, can you go back to the previous slide?
Okay.
Yeah, then between lump sum and dollar cost averaging, the general rule of thumb is time in market is actually more important than timing the market. If you are uncomfortable with volatility, then dollar cost averaging on a monthly basis may turn out better for you because you are putting in a smaller sum every single month. And so when the market goes downward volatility, at least you have the comfort of knowing that you're buying at lower prices. But personally, if you were to look at the super long run, I'm actually quite comfortable with going for lump sum investing, because even if the stock market were to pull back every now and then, I take comfort that over the very long run, I'm still going to yield back a better return when it comes to looking at 20-year horizon. Yeah, back to you, Jason.
Okay, thanks Thomas for sharing your point of view as well. Right. So selection of funds, okay, some people say that it doesn't matter. So long as you stay invested, it's okay. Okay, but to me, it make a difference. Okay. So what I do is I actually tap on resources in the market. Okay, in the internet. Citywire Asia is one of them. Okay, it's an international benchmark and performance ranking kind of website where they rank all your fund managers, all your funds performance out there. Okay, and there's these three key things that I look into: the returns performance, the standard deviation, and maximum drawdown, which I will explain later on also, for us to understand better why these three criteria. Okay, so why I do this, okay, as an investment tracking terms, I explain to you guys. Returns wise is all about absolute performance. Standard deviation is the range of volatility. Then maximum drawdown is the extreme end a fund can drop in the event that something major were to happen. Okay, so for illustration purposes, okay, because I believe a lot in China market, I will use China market to show the illustration. Okay, so as you can see, there's a lot of funds performance in terms of the individual funds. So there's rankings here. So the funds that I'm selected on my own through CPF investing is FSSA Regional China A shares. Okay, so why I choose this is because after looking through the returns, I think for CPF investing, we all know that 2.5% is the amount given to us, right? Okay, to me, while this fund performance isn't the best of all, okay, but because it beat the benchmark, which is okay, your 2.5%, I think a year of returns of 43% is really not too bad since last year, since the crash. Okay, and why I chose this, then we need to look into the next two criteria, which is standard deviation. I don't want it to be super volatile. So for the ranking, how it makes sense is that the higher it ranks, the better it is. That means your volatility wise is slightly better in that sense. Okay, and when it comes to maximum drawdown, okay, the higher it ranks, it means that this particular fund, right, has its maximum drawdown managed well. So when it comes to risk management, this is how I want to see whether does it form part of my criteria to invest into. Because especially we are talking about CPF investing, we need to select the right funds to accelerate our wealth. Okay, so moving on, if you look at this, right, okay, this fund actually outperformed the sector averages. So if you look at 5 years performance, usually 1 year might not tell you a lot of stuff, because like I say, crisis happens and that's why the returns is high. But in order to gauge whether this fund is performing at a sustainable level, we have to then look at a longer horizon. But of course, I don't, okay, disclaimer first, doesn't mean that past returns equals to future returns, like what I always say. But at the very least, it can allow us to make some informed choices, informed decision moving forward. So when you look at this particular fund, okay, a performance of 118% over 5 years, okay, to me, it means that you're growing your CPF at a way faster rate compared to your 2.5%. But of course, this also means that you put 100% into China, which most of the time, majority of investors won't do that, unless you are a firm believer of 100% equity, which I am, and Thomas is also. And you're willing to see the bigger picture, which means that your horizon is at least until maybe you're 55 years old. Why that age is because that's when you can withdraw your excess amount out. Yeah. So if you can see the bigger picture, then the volatility that happens, that took place, if you look at the chart, okay, doesn't matter to you. Why so? Because you're investing in the long run horizon. You are not here to cash in on quick profits. Yeah. So that's how I see things also. Of course, I'm not advocating for 100% to China.
Yeah, personally, I'm not 100% into China also, but there's no doubt that China as a country is growing very fast. But whenever we invest in China, we must always understand like what is happening recently. You know, there could be a lot of new regulations that is coming up. So I keep my China position to a limited amount, generally about 10 to 20% of my portfolio. Most of my investment would still be in the United States. Yeah. Back to you, Jason.
Okay, thanks, Thomas. So moving on, we then look at the funds, standard deviation, like what I mentioned. So the standard deviation, if you look at the returns versus risk, if you look at the diagram itself, it's actually performing quite good in a way. The volatility is actually slightly lower than most of the funds out there, yet still able to deliver you the kind of returns that is very lucrative when you use it through CPF OA investing. So that's the rationale behind why I chose this fund also. Yeah. And moving on, if you if you to look at this itself, okay, maximum drawdown. Okay, the maximum drawdown is negative 7.3% for 1 year period. But over 5 years period, the negative drawdown is negative 21.6%. So if you can weather through this type of volatility and you know that this fund itself is one of the better ones, top 10% of its as compared to the rest of the funds out there, then you should be more assured that the funds that you choose, which is what I'm actually showing here, does make sense and it fits into your criteria of growing your CPF OA funds. Okay.
So Jason, could you explain a bit more on standard deviation and what does it mean for the layman?
Oh, okay. So basically, when you look at standard deviation itself, right, we are looking at the volatility. That means how it fluctuates in the long run. Okay. Sometimes, like what I say, risk appetite. Imagine today when you sleep and you wake up the next day, for example, a dip of 40% happens. I'm not sure whether can most of the investors out there, mass market investors, accept this. Some might panic and sell off. You see, if you do not have a disciplined framework for investments, when you see this type of dips, you will really panic. Okay, so sometimes you might make the wrong decision, for example, perhaps selling off some of your portfolio because you see the dip and you can't take it. Okay, so that itself, when you translate to standard deviation, that's why I say sometimes you can go for absolute performance. You can only choose absolute performance. That means your top 1 to top 10 funds out there. But sometimes volatility might actually kill you if you do not have a strong framework to invest, or psychologically you're not strong enough yet to manage that kind of volatility.
So basically, investors who are concerned about the day-to-day market fluctuations, then they have to pay attention to standard deviation.
Yes, exactly. That is just for a peace of mind for them in the long run also.
Right. Okay. So generally, if you are a more passive investor, standard deviation just means like the stock market, or rather the fund that you're buying is not as volatile. I'm going to share my experience as an investor because I like to select stocks. So I usually detach volatility from risk, meaning I don't see the prices moving up and down as being risky. But what I focus on is generally the business fundamentals. But this is slightly different from fund selection. So as investor, usually when it's volatile, I see this as a good thing because it actually gives me like very good entry points at different pockets of the market. And when you look over the very long run, like the chart I showed you earlier, on the S&P 500, there's going to be like 40-50% dip every now and then. But when we look at a more than 20-year horizon, right, it's going to compound at between 8 to 12% annually. It is never going to be a smooth line, but investors can take comfort that over a super long run, the risk of you losing money actually diminishes. Yeah, back to you, Jason.
Okay, thanks Thomas for sharing. So like I say, unit trust investing is slightly different from stock picking and stock investments. So these are the criteria that we should pay attention to in the long run, given that there's different risk appetite for different people. Okay, so moving on. So when we talk about funds, we can't avoid the topic of fund manager. Okay, I'm not sure whether most investors today look into fund managers, but to me, unit trust investing, right, is almost like, okay, for example, your stock picking. Stock picking, you look into the culture, the management, all this, right? Okay, so how for the case of unit trust, how does performance come into picture is we have to look at who's the one managing the fund. And to me, that plays a part in determining the returns and how risks are being managed. Okay, that's why I choose to move a step deeper. I look into fund managers. Okay, so for this particular fund itself, okay, the fund manager is called Martin Lau. If you go online to look up, okay, he has been in the China market for very long. He has been managing a lot of different China funds under FSSA. Okay, why I chose him is because I believe in his way of investing. His philosophy to invest towards investing is slightly more active also, and second, is bottom-up approach. So he's done his whole team actually does the homework back end. Okay, and if you look at his rating under CityWire, right, is A rated. Okay, his performance might be average. Okay, but why I still chose him is because of the fact that when it comes to maximum drawdown and standard deviation, he's one of the best out there. Okay, so in the long run, if you don't want to see the kind of extreme fluctuations, or in terms of risk management, you see the maximum drawdown being more than a certain percentage, like for example, more than 20%, 30%. Okay, you are afraid that might influence you to sell off your pot, right? So in order to not make irrational decisions, they look into how fund managers manage the funds, and which is why this is how I select Martin Lau as the ideal choice to grow my wealth in through CPF OA investing. All right. So 1 year horizon might not show a lot of stuff, but like I say, if you drag it along 5 years horizon, in terms of performance wise basis, Martin Lau, on average, his funds, okay, this is in the region of Greater China, So his performance is quite okay, to be honest. Okay, so to me, that's why eventually I select Martin Lau as the ideal choice for me to invest my CPF. Okay, because when it boils down to investing, we are always talking about sustainable investing. Okay, we don't want to risk our portfolio dip a lot and make the wrong decision by selling off. Yeah. So I'm not sure how, Thomas, how do you actually go about selecting sometimes?
So for me, most of my investment using CPF, I would use endow us directly into S&P 500. But if I were to evaluate unit trust, right, generally the biggest mistake for most investors is you look at 1 to 3 years investment performance. What you want to look at is a much longer period because there will be a lot of flash in the pan. So you want to look at managers who are able to deliver results consistently and not just within a short period. Generally, I would like to look at their results between 5 to 10 years. In this case, sometimes they may not be the cheapest managers, meaning like the fund expense ratio, etc., is a bit high, but if they are able to generate high returns, then they may be worth their salt. So rather than just looking at fees, we must also look at their long-term performance. Definitely do not just invest based on 1 to 3 years results. Look at 5 years at least and beyond.
Yeah, definitely. That's very true. Because the longer the track record, the better it is for us to choose the right fund managers out there who has credentials, most importantly. Yeah. Okay. So if you look at digest this whole information from FSSA regional China, of course, you look at it per annum, it's equivalent to 23.62%, which is quite a decent return, because if you compare it to, like what I say, CPF OA is only 2.5%. Okay, so look at the amount of investment, assuming that let's say you do a first year lump sum 10K investing, and subsequent years you do 5K for the next second to fifth year. So your total capital invested will be 30K through CPF, but your amount accumulated will have been 68,814. So effectively, you already doubled your money to really beat your own record investments, right? Okay, you need to set certain benchmark, and of course, the very first thing you need to do is to first put in effort and perhaps make some mistakes. But of course, now if let's say we have endowers helping us to invest, I think that there won't be any mistakes. It's the kind of investment strategy you choose, because if it's passive, then to be honest, there isn't much you have to do by default. Okay, but because I tend to like semi-active investing, it'll take up a lot of my time, but I like it because that will train my brain to think, to make investment decisions also. Okay, so along the way we fine tune it. Eventually, we will really get to enjoy the whole process at a later stage, whereby you see you actually doubled your wealth at a faster rate because you know how to deploy your capital in a more efficient manner. Okay, so really today the objective is to encourage people to think about CPF investing, how it can help to accelerate your wealth in the long run.
If you guys are interested in learning more about Jason and finding out how to actually go about fund selection, I will include his contact in the show notes, the description in the YouTube video. You can go ahead and check him out. Otherwise, if you're interested in learning more about how to do individual stock picking, you can head on to steadycompounding.com. Thank you, everyone.